as we address the issue from the IMF's World Economic Outlook, which this morning broke the news that global growth now projected to fall negative 4.9% in 2020. Joining us to discuss this and much more, we have Brian Chung from Yahoo Finance, but also Gita Gopinath. She is the IMF Chief Economist. And those headlines are troubling, but there was something in the report that stuck out to me, that 300 million full-time jobs will be lost in the second quarter worldwide. Will those jobs come back?
So indeed, this is an unprecedented crisis, and we have downgraded. So we're projecting a deeper recession in 2020 and a slower recovery in 2021. Now, the sectors that have been hit the most are what we call labor-intensive sectors like hospitality, leisure, tourism. And while countries, as they reopen, we are seeing improvements and we're seeing recoveries, but in these sectors, those are still depressed. So our projection is for a very gradual recovery. So even by the end of 2021, for most countries, we're not expecting either employment rates or overall GDP to be back to pre-crisis trend. Again, there are risks and there's uncertainties about the outlook. So it's going to be hard to precisely say when the numbers will come back up. But this is going to be a gradual recovery.
Gita, it's Brian Chung here. Thanks for joining us. I wanted to ask, compared to the last time you provided these estimates, which was back in April, it seems like there's been a lot of developments, and it seems like if there is any sort of upside risk, we would have seen more of it now than we did back in April. But I'm wondering, at large, do you see the upside risk as maybe outweighing the downside risk when you look at things like strong signs in China, as you reported to in this outlook, or things like here in the United States with the May jobs report? What do you think is greater right now, the downside risk or the upside risk when it comes to thinking about that recovery in 2021?
So, an important difference since April is that in April, when we had our projections, we put out two alternative scenarios, and both were worse than the baseline. So I think there we were clearly thinking that things could only go in one direction. This time around, we actually have both an upside and a downside. Now, on the upside, you could have better news on treatments and vaccines and on more policy support, and that could get the recovery back up much more faster. But on the downside, we could have the second wave. You could have tightening financial conditions. You could have trade and geopolitical tensions. I don't think I can at this point tell you that, it's on balance is one or the other. I still think there are significant downside risks going forward.
One of those risks that you just mentioned is trade, and you specifically mentioned escalating tensions between the United States and China. We saw that rocking the headlines earlier this week. Do you think that trade will return to be one of the larger kind of market risks, I guess, if you will, to the global economy? And how do you think that fiscal policymakers and heads of state should be approaching that?
It is an important risk. It's been, we're going through the worst crisis of many generations. So I think we've stopped thinking about trade tensions, but that is very much there. And if that does return, given that the world economy is already being hit so hard and productivity is being affected, the repercussions will be quite severe. So this is an important one. But among the risks going forward, of course, I think the big one would be if there was a second wave. Because if you look at what has led to these big downgrades right now for many countries, it is the domestic impact. It is the fact that activities are basically shut down in many countries, though they are reopening.
Gita, it's Julie here. Speaking more about sort of upside versus downside surprises, here in the United States, in general, there have been upside surprises to the economic data, even though it is still obviously weak. It has been trending upward. It's been beating economists' projection in many cases. So how do you sort of square that with this newly more pessimistic forecast? And when you look around the globe, where do you think the source of most of the downside will be happening in terms of the weakest areas?
So the revision came for two reasons. One is that the length of the lockdowns, the intensity of the lockdowns, and its impact on activity in the first half of this year came in somewhat worse than we had anticipated. The second is because we don't have a medical solution yet. The health crisis is not over. So we are projecting much more persistent social distancing into the second half of this year compared to what we had in our April projections. So those are two reasons. Now, we would expect, now the first half of this year was definitely the worst for the global economy in terms of the depth of the collapse. And now as countries are reopening, we expect to see an uptick, and we are seeing that. So even in the case of the U.S., it's been the growth, the employment numbers are welcome. They show signs of improvement. But if you look at the overall unemployment claims and how stable they have stayed at the kind of around the 20 million mark for the continuous people who are continually getting unemployment claims, I mean, that suggests that it's going to take a little while to get returned back to pre-crisis levels. And in terms of overall, I'm sorry, just to the question of overall, where do we think of the biggest downgrades? The biggest downgrades have been across the board, actually. I mean, it's been in advanced economies and in emerging markets and developing economies.
Yeah, we saw that, especially with the Eurozone and with the Latin America. But I wanted to ask about the U.S. dollar really quickly, depreciating by 4%. What is that going to do? I know trade flows are not operating normally, but what are the implications of that?
Well, I mean, the reason the dollar has depreciated some is a combination of the fact that we moved from a risk-on period, which was in March, to more of a risk-off period, which was in March, to more of a risk-on period. And so we've seen capital flows stabilize, the flows that went to emerging and developing economies. We've seen equity prices rebound in many countries. We've seen credit spreads come down. And so that's what you expect, which is that as the world economy is improving, you would expect to see that there would be, the original strengthening of the dollar would reverse itself. In terms of implications for trade, I mean, I think the bigger implications are what we are seeing in terms of overall demand for goods around the world with the sharp contractions that you see.
And we're watching that because it's something that, I mean, it's front and center. We have to say thank you, Gita Gopinath, IMF Chief Economist, for joining us on The Move. We'll be right back.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.